Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 10, Taxes 101. Many people are intimidated by income taxes. The U.S. income tax system is complicated. Every year around tax time, you can hear politicians and pundits complaining about how many pages of laws there are around taxes and how you need an advanced degree in order to understand it all, and probably not even then. While I do agree that our system is too complex and should be made much simpler, I also think that for the vast majority of individuals, income taxes are actually pretty straightforward, easy to understand, and easy to complete. This is because most, but not all, individuals have fairly simple tax situations. They have income from their job to report, plus perhaps some interest or investment income. They may even have some side hustle income to report, but unless they are completely self-employed in a complex business, this is pretty straightforward as well. And most people are going to take the standard deduction, around 87% did for the 2023 tax year, plus maybe a few extra deductions or credits that are pretty easy to understand. Then, to top it off, they'll use tax software to complete their taxes that will step them through everything they have to do. Some folks, in some states, can use the IRS's direct file software, although at the time of this recording, the current administration is talking about getting rid of it. If you can't use that, there are many other choices of tax software, including the one I use, which is called Free Tax USA. I used to use TurboTax, but switched a few years back because Free Tax USA works just as well. I actually like it a bit better, and is free for filing your federal taxes. While you can choose to upgrade and pay $7.99 or $49.99 for advanced levels of support, very few, if any, people need to do that. So it truly is free for filing your federal taxes. I live in Colorado, which allows us to file our state taxes for free online. So I don't use Free Tax USA for that. But if your state doesn't offer that, or you just want the convenience of using Free Tax USA, they charge a very reasonable $14.99 to file your state taxes. So let's learn the basics of how our tax system works in order to make some basic decisions around optimizing your taxes. To be perfectly clear, this will not be a comprehensive explanation of our entire tax system, but will be a simplified look at the things that most people need to know and understand. I'm not a CPA or a tax expert, but that's kind of the point. You don't need to be to understand the basics of your taxes and how to make good decisions. Many people don't think about it this way, but taxes are really just another expense. It's money you have to spend and therefore can't save and invest, which means that taxes are just like any other kind of spending, and there are techniques you can use to minimize how much you spend, how much you pay in taxes. In order to do that, you need to understand some basic terminology as well as how your taxes are calculated. Both your federal and your state income taxes, if your state has income taxes, are based on your income, which seems simple enough, but turns out to be somewhat more complex. You start by adding up the income you receive from your job. Simply add up your gross income from each of your paychecks. If you work any other jobs, you could add that to your total as well. We'll talk about self-employment income later in this episode. That may seem straightforward enough, but interestingly, that's rarely a number you will actually put or even see on your tax return. Instead, your employer will send you a W-2 form in January, and in Box 1, labeled Wages, Tips, Other Compensation, you'll see a number that for most people will be less than the total amount you made for the year. Note, the exact placement of the boxes can vary depending on your particular W-2. The reason for this is pre-tax deductions that your employer already knows about and therefore doesn't report to the federal government as taxable income, and therefore doesn't show up in Box 1 on your W-2. Here are some of the most common ones. As discussed in episode 6, the premiums that you pay for medical, dental, and vision insurance can, and usually should, come out pre-tax. As was also discussed in episode 6, if you contribute to a dependent care FSA, a medical FSA, a health savings account, or a limited purpose FSA, those also come out pre-tax. If you contribute to a pension, that also typically comes out pre-tax. And if you make optional pre-tax retirement contributions via your paycheck from your employer, such as to a traditional 401k, 403b, or 457b, those are also pre-tax. All of these pre-tax deductions are already reflected in Box 1 of your W-2. Your employer already subtracts them from your gross income before reporting your income to the IRS. There are also many other pre-tax deductions that you can take that your employer doesn't know about. There are way too many of these to discuss them all, but here are three of the most common. If you contribute to a traditional pre-tax IRA, you can deduct this from your income on your taxes. If you make additional contributions to your HSA directly, not through your employer, then you deduct those separately on your tax form since they are not reflected on your W-2. And if you're an educator, you can deduct up to $300 for the educator expense deduction. You may also have some additional income that you have to add in, typically interest on savings accounts and perhaps dividends and/or capital gains from your investments. Interest is pretty straightforward. It just gets added to your income. Dividends and capital gains are taxed differently, and we'll talk about them more later in this episode, but just realize that they will factor into the taxes you owe. Again, don't sweat it. You have software that helps you figure out how to do this. So, when you add up all your income and subtract all your deductions, you come up with something called your adjusted gross income, AGI, line 11 on Federal Form 1040. But even now, this is not what you actually get taxed on, because now you get to take additional deductions. A small number of people, around 13%, will itemize deductions, but most folks will end up taking the standard deduction. The amount changes each year, but in 2025, it's $15,000 for single or married filing separately, $30,000 for married filing jointly, and $22,500 for head of household. There are also some additional deductions if you are over 65 or blind. This goes on line 12 of your 1040. When you now subtract the standard deduction, or itemized deduction if you're one of the few who have enough to itemize, you come up with your taxable income, line 15 on your 1040. Our federal tax system is what's known as a progressive system, meaning the amount and percentage of taxes you pay increases with your taxable income. In 2025, this is what the federal tax brackets for ordinary income look like. A really important thing to keep in mind is that the tax bracket you are in is your marginal tax rate, but is not your effective tax rate. For example, let's assume you are married and filing jointly, your AGI is $130,000, and you take the standard deduction of $30,000. Your taxable income is then $100,000, which puts you in the 22% marginal tax bracket, which means that the last dollar you earn is taxed at 22% at the federal level. But that doesn't mean all of your income is taxed at 22%. The first $23,850 is taxed at 10%, so you owe $2,385 in taxes on that part. The next $73,100, the amount from $23,850 to $96,950, is taxed at 12%, so an additional $8,772 in taxes owed. And the last $3,050, from $96,950 up to your $100,000 in taxable income, is taxed at 22%, so an additional $671 in taxes owed, which means you owe, at this point, more to come, a total of $11,828 in taxes. $2,385 plus $8,772 plus $671, which works out to an effective tax rate of 9.1%, taxes of $11,828 on an AGI of $130,000, although it'd be even lower if you calculated it on your gross income instead of your AGI. Note that this is significantly less than half of what many people in the 22% tax bracket think their tax rate is. If you have taxable investments, not savings type accounts which earn interest, or tax advantaged accounts like IRAs and 401ks, but taxable brokerage type accounts that can earn dividends or capital gains, these are taxed at a different percentage than ordinary earned income. This is what the capital gains tax brackets look like for 2025. I don't want to go into too much detail, but some dividends and short-term capital gains, investments held less than a year, are taxed at ordinary income rates, the tax brackets we discussed earlier. But qualified dividends and long-term capital gains are taxed at either 0%, 15%, or 20%, depending on your total taxable income. Which means that in our previous example, if any of the $100,000 in taxable income included qualified dividends or capital gains, your total taxes owed would actually be less than the $11,823 we calculated earlier. For example, let's say that $5,000 of that $100,000 was from qualified dividends and capital gains, meaning $95,000 was from ordinary income. Then the tax you owe would actually be only $11,418. $2,385 from ordinary income in the 10% bracket, $8,538 from ordinary income in the 12% bracket, $0 from the $1,700 in the 0% capital gains tax bracket, and $495 from the $3,300 in the 15% capital gains tax bracket. So your effective tax rate is now down to 8.8% of AGI, and probably much less of gross income. At this point, You have how much total tax you owe, line 16 of 1040. Well, sort of, because now you frequently have tax credits you can subtract. Unlike the tax deductions we talked about previously, which lower your taxable income, tax credits actually lower how much tax you owe dollar for dollar. So, dollar for dollar, tax credits are much better than tax deductions. Again, there are many possible tax credits. I will just mention some of the most common ones. If you have dependent children under age 17, you can receive up to a $2,000 tax credit for each of them. There are income limits for this that phase out the credit. There are tax credits you can receive if you purchase a qualified electric vehicle, solar panels, battery storage, heat pump water heater, or made other energy efficient improvements to your home. When you're first starting out and have a relatively low income, you may qualify for the Savers Credit, which gives you a tax credit for making contributions to retirement accounts. If you have children, or are yourself in college, you often qualify for the American Opportunity Tax Credit or the Lifetime Learning Tax Credit. And even if you contribute to a dependent care FSA through your employer, you may, and likely will, have additional daycare expenses above and beyond the $5,000 limit. A portion of these expenses can be used as a tax credit. The total of these credits are then subtracted from the total tax indicated on line 16, giving you your actual total tax owed on line 24. You have federal and state, and sometimes local, taxes withheld from your paycheck. You total up all the taxes withheld, box 2 on your W-2 for federal taxes withheld, and enter on line 25. The difference between what you had withheld and what you owe is either your refund, if you have more withheld than you owe, line 34, or your payment due, if you had less withheld, line 37. A quick note about vocabulary. Your tax liability is the total amount of taxes you owe, which is on line 24. People often mistakenly refer to the taxes they owe as the amount on line 37, when that is how much additional they have to pay above what they had withheld. And some folks, when they get a refund on line 34, will say, I didn't owe any taxes. But that's not true. They almost undoubtedly still had a tax liability. It's just that they are getting a refund because they had more withheld than their tax liability. They still paid taxes. This may seem like semantics, but I think it's important because people who are confused about this are fundamentally misunderstanding our tax system, and that can lead to suboptimal behaviors for them, as well as misinformed opinions on policy. The above examples assume you just have regular W-2 income from an employer and perhaps some interest, dividends, or capital gains. But some people also have self-employment income. People with self-employment income typically fall into one of two broad categories: full-time self-employed people and people who are self-employed as a side hustle. Taxes for full-time self-employed people are beyond the scope of this podcast. But most people who are self-employed as a side hustle will claim that income as a sole proprietor and simply complete Schedule C on their tax return. They will enter any income they have from self-employment, subtract off any business expenses if they have them, and then if they have a profit, that will get added to their 1040 form, line 8, which is then included in their AGI and will be taxed as ordinary income. But it's important to realize that in addition to paying ordinary income taxes on this income, you also have to pay self-employment taxes. That profit you just calculated also gets put on Schedule SE, the self-employment tax form. It is then multiplied by 92.35% and then again by 15.3%. Where do those numbers come from? Well, when you work for a regular employer, you pay 6.2% into Social Security and 1.45% into Medicare, as does your employer. When you add that up for both you and your employer, that's 15.3%. When you're self-employed, you have to pay both the employee and the employer share. So that's why you pay the entire 15.3%. When an employer pays their 7.65% total into Social Security and Medicare, it's a tax deduction for them. They don't have to pay taxes on that money. So when you pay the 7.65% employer share of the self-employment tax, you get a tax deduction for that as well. If you subtract that 7.65% employer share from 100%, you get 92.35%, which is why you only pay self-employment tax on 92.35% of your profit. This self-employment tax amount then gets computed on Schedule 2 and then added to your total tax liability on line 23 of your 1040. State taxes vary, of course, depending on what state you live in. Some states don't have an income tax at all, but it's important to realize that they usually make up for that with sales taxes, property taxes, and by other means. Some states have a flat tax rate. Colorado, where I live, has a flat 4.25% state income tax rate. And other states have a progressive tax rate similar to the federal tax brackets, where you are charged a different marginal percentage depending on how much taxable income you have. States also often have their own tax deductions and credits, sometimes including contributions to 529 college savings accounts, exclusions of some or all of any Social Security, pension, or other retirement income, and other items unique to the state. That's basically it. That's taxes. Now, to be clear, there are many complexities in the tax code, and I don't mean to minimize those. But for most people, what I've discussed covers the vast majority of what you need to know about how your taxes are calculated. And now that you understand this, you can better understand ways to optimize the expense that is taxes. You generally do this by increasing your deductions to your income or taking advantage of additional tax credits. As talked about in episode 6, having insurance premiums come out pre-tax, contributing to dependent care FSA, medical care FSA, HSA, and/or a limited purpose FSA are pretty easy ways to reduce your taxable income. The other main way is to contribute to traditional tax-advantaged accounts like IRAs, 401ks, 403bs, and 457bs. We will talk much more about these accounts in a future episode, but for now, just realize that each of these comes in two flavors: a traditional pre-tax version and a Roth version, which is post-tax. Only the traditional pre-tax version reduces your taxable income now. So every dollar you contribute to a traditional IRA, 401k, 403b, or 457b reduces your taxable income by $1, lowering your taxable income and therefore your tax liability. And then tax credits, such as the child tax credit, EV tax credit, solar, heat pump, and heat pump water heater tax credits, the American Opportunity and Lifetime Learning tax credits, and many others directly lower your tax liability dollar for dollar. So you want to make sure you're claiming all the tax credits you're eligible for, but also occasionally being proactive about taking advantage of some of them that you don't necessarily qualify for by default. For example, if you're looking at buying a new, or new to you, car, there are tax credits if you purchase certain EVs. Or if you own your house and need to replace your HVAC system or your water heater, look at replacing them with heat pumps. Not only are they less expensive to operate in the long run and create less pollution and help fight climate change, but the tax credits will dramatically lower the upfront costs. Before we finish up, I want to mention one more item that most people don't think about, but many of you can take advantage of. That's the incredible opportunity a Roth IRA provides if you have a working teenager or young adult. In order to contribute to a Roth IRA, or Roth 401k, 403b, or 457b, a person has to have earned income. Many teenagers and students in college have part-time jobs where they do have earned income, so are therefore eligible to contribute to a Roth IRA, or Roth 401k, 403b, or 457b if their employer offers it. Most people this age aren't thinking at all about retirement, nor are they particularly enthusiastic about saving very much of what they are making. And, to be clear, many of these young people have to spend the money they are making to make ends meet. But if you are a family with privilege and have teenagers or young adults who are working, you can help them get started on the right financial foot. How? By providing the employer match for their contributions, or in fact, the entire contribution if you want to their Roth account. Again, they have to have earned income. But if they do, it doesn't matter if the contribution to their Roth account comes directly from their income or comes from money that you supplement to help them out. Because they typically are not making a lot when working part-time, they are in a very low tax bracket, often owing no taxes at all due to the standard deduction. So it totally makes sense for them to contribute to Roth retirement accounts over traditional retirement accounts. And because they are so young, they have an incredible number of years ahead of them for compound interest to work its magic. We've done this for our daughter, and she now has an incredibly healthy Roth IRA and Roth 401k in her mid-20s. To be clear, not everyone can do this, as many of those young adults have to spend the money they make to make ends meet. But for those of us with privilege, this is an incredible gift to give your children, while at the same time helping them develop good saving and investing habits. I highly recommend you now take a few minutes to look at your most recent federal and state tax returns and see how the information on them corresponds to what we've talked about. And think about if you're taking all of the steps you can to lower the expense of taxes by increasing your deductions or claiming tax credits. If you are taking notes throughout this series, write a paragraph or two reflecting on this exercise. If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. Taxes shouldn't be scary, and you shouldn't feel intimidated or overwhelmed by them. They're simply another part of our financial lives and, most of the time, for most of us, reasonably easy to understand, complete, and optimize. In our next episode, we'll begin talking about investing.